Hello, everyone. Thank you for being with us today. We're very excited to present how to prepare your business for sale. My name is Bill Chapman. I'm a partner at Baker Tilly US, where I lead the transaction advisory services team firm-wide. Here with me today is my colleague, Cameron Reed. Cameron?
Hello, everyone. Thank you for joining us today. As Bill mentioned, I'm Cameron Reed. I'm a senior manager at Baker Tilly. I am in our supply chain management practice. My focus at Baker Tilly is on supply chain operations and achieving cost savings for organizations through improvements associated with the supply chain.
So what we want to cover today is a step-by-step guide to prepare your business for sale. So step one, are you ready? Are you really ready? Have you put your team together? What is the company really worth? What might it sell for? Have you done a thorough assessment of your business? Can you make the appropriate changes? Do you have the time to do it? Can you monitor the results and then make adjustments again? So with that, we'll move on to step one. Are you really ready for sale? So first question that you need to ask yourself is, why do I want to sell? What's the real reason? And is there another way to accomplish that goal? Is it for retirement? Is there an external pressure that's driving you to sell? Do you want to, can you accomplish that through an ESOP, an IPO? Can you gift to the next generation? All these things need to be considered. What stage of development is the company in? Are you a startup? Are you a more mature company? Your process and your preparation might vary dramatically depending upon what stage of development you are. Has the company ever been valued? And for what purpose? A valuation is not the same as the price. As there's an old adage in our industry that value can be calculated, but price is always negotiated. So a valuation may have a very, very different outcome depending upon its purpose and the standard of value that's being used. How strong is your management team? Will they want to make an offer? Are there any family members in the business? What are their responsibilities? Are they fairly compensated? We've seen situations where, the nephew comes in at 10 o'clock, opens the mail, has lunch, leaves at 2, and it gets paid $200,000 a year. Not really adding a whole lot of value to the enterprise. And if he doesn't understand that that's really an advance, that $200,000 is an advance on his inheritance, then guess what? His lifestyle is going to have to change if you sell the business, because that won't be tolerated going forward. Is your estate plan funded? We like to say that your estate plan, your trusts funded with closely held business stock, needs to be old and cold by the time you go to market. So that's something that you need to look into. What's the company's competitive position within the marketplace? Are there any adjustments that you can make there? What risks are specific to the company? Concentrations, key man issues, that sort of thing. Can you make any adjustments there? What's the general condition of the company? Are assets maintained well? Are there any unrecorded or underrecorded liabilities? These are the kinds of things that you need to take into consideration. And very importantly, how much time do you have to prepare? That can dictate what adjustments you can make that Cameron will get into more detail in a little bit. So the next step, step two, put the team together. Your internal team is the first step. Who needs to be in the loop? Certainly your CFO or your controller needs to be in the loop. Your IT person may need to be in the loop. If you have a general counsel, that would make sense as well. But you want to have some of these people. You don't want to have the CEO/owner running around looking for bank statements for the last 12 months. It's going to raise a lot of questions, and it's going to take you a long time to do it. It slows the process down. And as we like to say in the industry, time is not our friend. It's about speed. So you want to have the right people on your team internally. You also want to have investment bankers. It's a critical part of the process. They will make the market for your business. They know what's customary. They'll know what kind of price you should expect. They'll know what kind of deal structure you should expect. They're an important part of your team. Attorneys, it's very important that your legal counsel be very familiar with transactions. You don't want to hire an estate planner. You don't want to hire a litigator to represent you in the sale of your business. There's a great deal of customary processes and procedures and customary legal documents that if you don't know what you're doing, small insignificant things get blown out of proportion, and things that are very important get missed. So you want to make sure you've got the right team there. Of course, you're going to want your accountants and your tax professionals and other consultants that may be applicable to your specific business, like actuaries or environmental professionals, regulatory professionals. All those people might need to be part of your team eventually. So step 3, what's your business worth? So what we have here is the Gordon model. And the Gordon model is essentially a very, very simplistic evaluation model. And it's a good way to conceptualize the variables that you need to think about as a business owner. So it's really about cash flows, the relative riskiness of those cash flows, and the sustainable growth rate. So what this is essentially the present value of a growing perpetuity. Like I said, it's very simplistic, but let's break it down a little bit. So the cash flows, a lot of people have probably seen or heard EBITDA being the metric that's the most important. Well, it's a very important metric, but it's not the be-all end-all. As we like to say that if you have a business that doesn't have any net working capital, doesn't have any capital expenditures, and doesn't pay any taxes, then yeah, EBITDA is a perfect metric for you, okay? But debt gets underwritten to free cash flows. The sophisticated buyers will make decisions based on free cash flows, not just on EBITDA. So that's one of the things that you need to be aware of, these other components. When we're doing due diligence, if you see the EBITDA as a hockey stick and you see the free cash flows 45 degrees into the dirt, you've got a problem. And so you want to make sure that you're aware of those problems potentially before you go to market, not finding out when the buyer's due diligence team comes in. So other things that you want to take a look at, the relative riskiness. Some of these things are within your control, some of them are not. The general economics, the economic environment, the industry specific, how fragmented is the industry, how responsive are your competitors to a price change, for example. Those are risk profile issues. But then the things that you can control, perhaps, is company-specific risks, also known as unsystematic risks. These things might be key man issues, customer concentration, intellectual property concentration, channel concentrations. All of those kinds of things are an aspect of risk. Vendor concentrations would be another one. So growth, how sustainable is it? Did you have one big project this year? You're not going to be able to sell off of that. No one's going to buy that one project. That will go back to, quote unquote, normal after that. So it seems pretty obvious that, what you want to do to maximize your value is going to be, you want to pump up your cash flows, reduce your risk, and maintain your growth or improve your growth if it's possible, depending on your time frame. So Cameron will cover the cash flows and the risk issues and how you might be able to improve those in just a few minutes. The next step, we've used here a quote from Sun Tzu in The Art of War, and it really kind of captures it. If you know your enemy, the buyer, and you know yourself, your company, you should never fear the result of 100 battles. And so it's really about self-assessment. You know who the buyers are going to be, private equity, a strategic perhaps. But if you know yourself, you've got it, you're ready to go. And so the first step there in step 4 is to get organized. Your books and records, they need to be clean. They need to be wired tight. Banks need to be reconciled every month. The balance sheets need to balance. The retained earnings need to roll. You need to have posted all of the journal entries that your accountants have suggested. You've got to be careful about systems that are antiquated and information that's hard to pull out of it. If that's the situation, you don't have time to reinvest in an ERP system, then you need to have the ability to start pulling that historical data down, so that you have it ready. And your accountants can help you with what kind of information will be requested by prospective buyers and their teams. So one of the ways to do that is through a quality of earnings study. And so a quality of earnings study is really having a due diligence study done on yourself, on your own company, in anticipation of taking the business to market. So what you've got there is a dress rehearsal. You're getting asked the tough questions already. You've got all the documents that you need in your virtual data room. You've got all your adjustments already vetted. All the issues are on the table. All of that speeds the process, and it helps protect you against what's known in the industry as a retrade, because if a buyer finds something that you weren't aware of and didn't highlight to them, they will try to change the deal. And so that's something that you need to be careful about. So the other part of it is to make sure you didn't leave any money on the table with a quality of earnings study on yourself, the sell side due diligence, if you will. There has been a number of occasions where we've identified as much as $1 million adjustments to the favor of the seller that they would have never have identified because they weren't familiar with how a third party might look at their business. And the reason you want to be careful about that is that a buyer is never ever going to highlight that to you. Okay, so you want to make sure that you've got that covered, and a sell side due diligence certainly will do that. Now, we often get asked, well, I get an audit. Do I really need to prepare like this? And so the idea here in this table is that the audit versus a diligence process are very different. The focus of the audit is on the past, due diligence, past, present, future in the form of projections. The scope is defined by GAAP in an audit. It's defined by the client in the due diligence. It's unrestricted access for the audit, but it may be restricted for the due diligence. There's more substantive testing in an audit than there might be in a due diligence. The audit is in a regulated format, whereas the due diligence is a consulting engagement, for example. The focus on an audit is the balance sheet, not the cash flows like in a due diligence. And one of the most important things that people miss is that the materiality is different in an audit in a due diligence. The materiality in an audit is based on sales and on the total assets, where the materiality is based on EBITDA. And so you've heard how people describe the value as a multiple of EBITDA, even though that's not how it's actually calculated. Think about a positive adjustment of $1 million and you're selling for 10 times. That's $10 million. Okay, so it's a geometric impact on the materiality. So you want to be cognizant of that as well. So another thing to think about is how a buyer is going to look at you. Okay, what are they thinking about? So they're going to want to know, how committed are you to the sale? Are you really serious about this? Or are you just kind of like fishing around a little bit? Communicating your goal. They're going to want to know, why are you selling and does it make sense? Retirement, like we said before, things like that. There's no, you don't have an heir apparent. That all makes sense. On the other hand, we've had people like tell me, I want to sell because I just don't want to, I pay too much in taxes and I don't want to have my business anymore, which is like one of the most ridiculous answers I've ever heard. Okay. So, but we have heard them. So you want to have, when you're going through the process, you want to have timely, thoughtful responses. Again, being prepared. You want to have the appropriate expectations of the outcome. That's your investment bankers helping, your attorneys helping you with that. The appropriate representation, your bankers and your attorneys. The management team, are they responsible? Are they have diversified skill sets? Are they incentivized for the sale? Perhaps a loyalty bonus that gets paid for a successful transaction 6 months after the deal closes is appropriate. So those are steps 1 through 4. I'm going to turn it over to Cameron now to talk about steps 5 through 7. Cameron?
Thanks, Bill. Appreciate the lead into this. Now, then the next section, as we talked about, as Bill mentioned, steps 5 through 7, it's really about making adjustments. And I'm going to get into both some strategic views as well as some tactical views of how you actually improve the value position of the organization in preparation for that sale. So in looking at this, we have really developed a number of, specifically 5 guideposts associated with shaping businesses today. Some of these we can deliver impacts to, others are more knowledge-based. You have to be aware of them. So as you're looking at the screen here, you see, geopolitical and social and economic risk. Bill mentioned risk earlier in this conversation, and this is where that really starts, is what are some of those broader risks? Not that you can necessarily change the risks themselves, but specifically that you're aware of them and that you know what what the potential impacts are on the organization. And it's more of an awareness issue than anything else. Furthermore, there is the second guidepost is really understanding any sort of disruption-based competitive pressures. Again, this is not necessarily something that you can directly impact. However, having the knowledge of what disruptive technologies or trends in industry are facing the organization can help drive strategic as well as tactical approaches to the operations of the business. The third guidepost is focused on rapid foresight processing and planning. This is a fancy way of saying data analytics. What type of information is available and how can you take that information and move it into an actionable format? The fourth guidepost being what we refer to as supply chain DNA manipulation. As I mentioned in my introduction, my background is supply chain management. The supply chain of any organization deals heavily with the costs that an organization incurs. So when you look at the opportunity to enact savings measures, what you're really doing is modifying how your supply chain behaves, both internal as well as external. And the need and the desire of this fourth guidepost is to look at the way a supply chain behaves and really modify that behavior. And that's why we refer to it as DNA manipulation. The fifth guidepost associated with businesses today is really a sustainability issue. And this can be viewed not only as what's popular right now, that those green initiatives, or at least was popular before the pandemic, green initiatives in terms of sustainability, but also the sustainability of the cost savings efforts that you're going through in order to improve the valuation of your organization. Now, as I've alluded to, a couple of these, the geopolitical risk and disruption-based competitive pressures, they're really reactive categories. We all saw how we reacted to the pandemic and COVID-19 when that emerged last year about this time. And quite honestly, there was very little planning that went into anyone's organization. We just jumped into, we have a problem, we're now going to solve it. The other three, the rapid foresight for processing and planning, supply chain, as well as sustainability, those can really be anticipatory activities. And that's what we want to focus on as we look at how to improve the value position of an organization. In other words, those three are controllable. So as we look at the three, there's those last three, they really have two subgroups to them. So the first two, guideposts 3 and 4, are really about creating a platform for growth for the organization. And while I like to focus on cost savings, the reality is as we identify areas of cost savings for an organization, that also presents an opportunity to grow the organization. And when we manipulate and utilize the data analytics associated with Guidepost 3 and manipulate a supply chain and how it is behaving, what we're actually doing there is providing a platform ideally for a growth situation, but also it also enables an organization to be nimble enough to address any sort of, we'll call it a black swan event that may occur in the future. The second subcategory being that sustainability, and I talked briefly about this, it's not just being able to maintain growth, maintain savings, but it's also about risk avoidance and how to identify coming out of the geopolitical, social economic risks and disruption-based technologies and competitive pressures, how to take that information and absorb it within the organization so that you are prepared to address those risks as they occur. So let's dive into some of the details associated with each of these. I'm going to skip over the first two because those are reactionary type categories, and I'm going to focus on what is controllable. So again, let's start with the rapid foresight, processing, and planning. Some of the first things that we need to do associated with this is it's about the integration of supply chain and enterprise strategy. Just because we have a supply chain strategy or an enterprise strategy for the organization doesn't mean they are necessarily tied together closely enough. So one of the first steps in this is making sure that those two plans are in lockstep with each other in order to achieve that maximum value for the organization. We also want to be able to identify alternative business models. Whether those models are focused on creating capacity for growth, creating resilient sourcing options within the supply chain, or being able to proactively react to any situation that might arise in the future. So it's really a focus of being able to have plans that, given a particular situation, we can adjust accordingly and really just roll out one of those plans and execute. There's also the identification of economic and strategic benefits or downsides to changes within the supply chain and within the business operations. And in order to fully understand that, it really drives at the analytics that are necessary to support this type of decision making and modeling. And that's where this particular guidepost really takes us. It's the alignment of plans and then moving towards the analytic aspect to ensure that we have appropriate models in place and that we are continually reviewing them. That kind of drives into that sustainability aspect, but we want to focus on being able to have the information first. So that really drives us at leveraging our integrated data in order to act. Now, what I have next to show you is some examples of what this might look like. And I know this is a busy slide. However, this highlights some of the capabilities that some technologies have been brought forward that allow us to really look at how a business operates. And we want to do a number of things. We want to be able to map historical performance. And whether that be in a graphical format or oftentimes working with financial professionals, they obviously prefer in many cases to see spreadsheets, balance sheet type formats. Both of those really are a focus of what is our historical performance and ensuring that we have the data that's readily available. Another piece of this is the quantification of capabilities, specifically asset capabilities. And depending on your business, this could range anywhere from a piece of machinery on your shop floor to the distribution network that you've established over time. But you need to be able to fully understand and quantify these specific capabilities. And this also goes to your valuation and being able to articulate what those capabilities are to buying organizations. And finally, another piece of all of this is the modeling aspect of this and looking at the end-to-end capabilities of the supply chain. The particular slide we're looking at right now I will be the first to admit, this is actual information coming out of one of our projects. And is focused on international operations, specifically in Mexico. But it highlights the type of information that we can graphically display and help an organization understand what their supply chain looks like and where optimizations need to take place. Which brings us to our next graphic, and that's really the quantification of the benefit opportunities. And as you can see, while I have very generic information here, every opportunity that is evaluated needs to be evaluated based on a very specific set of criteria. First and foremost is, what is the potential gross profit impact that this particular initiative has? And the second element is the difficulty level. The combination of those two presents will really show you where you have high impact opportunities to pursue. And we've classified these really in four items. One is the low-hanging fruit category, which, as the name suggests, tend to be initiatives that you look at and say, you know what, we just need to go pursue these because they tend to be easy to do. They might have a decent dollar impact, but at the end of the day, the decision tends to be, they're easy to do. Whether the result is $1 million savings or $1,000 savings, if it's going to cost me $100 to do it, I'm going to pursue it. Our other categories are the medium priority, which really, you have to think twice about doing those, not because they are less impactful necessarily, but because of the cost benefit of doing a medium priority item. It might make sense from a strategic standpoint, but in the same breath, the impact is probably fairly low. So those are some difficult conversations you have to look very closely at. The next category we refer to as high priority, high impact. These are not necessarily as easy to jump at as the low-hanging fruit category. However, they also tend to provide a higher benefit to the organization, likely at a higher cost of implementation or putting the particular program in place. Oftentimes, these are much larger projects and provide a significant benefit to the organization. The final category being our low priority. These are opportunities that when we look at, we recognize are difficult to achieve, possibly have a high cost of entry in order to execute the projects, and will vary in terms of benefit from being a high benefit to the organization to potentially being a low benefit. Again, when you are able to categorize all of your opportunities for improvement and look at the impact and feasibility of them, you can narrow down the specific opportunities to pursue in order to improve those that valuation and the business value for the positioning of sale. Now, moving on, our next guidepost I mentioned is supply chain DNA manipulation. My first statement around this one is in order to really pursue a supply chain manipulation, an organization must take a very assertive action in doing this. This is not something you would look at and say, well, I'll kind of do a little of this, but I'm not jumping in with both feet because it sounds risky. If you're going to go down the path of evaluating your supply chain and taking costs out of it, you really have to be very assertive in how you look at this and in the pursuits that are identified. Oftentimes this model, or when you look at modifying your supply chain, what you actually need to do is look at multiple alternative business models to pursue. And I'll use some examples here. Quite honestly, coming out of or going through and coming out of the pandemic, there's been a lot of conversation about the supply chains reaching into China. I have had countless conversations with organizations looking to minimize their exposure in Southeast Asia due to the potential of supply chain disruptions. Clearly, we're jumping into a geopolitical landscape here in those conversations. However, they are true valuable conversations. In some cases, moving some of those manufacturing capabilities or even the supply base from Southeast Asia to North America does make some logical sense. In the same breath, if you have and are conducting business in China, not having a presence there all of a sudden is not just detrimental, but will most likely close the market entirely to your business. So there's a lot of consideration to look at in evaluating your supply chain DNA, and that's why there are multiple and alternative business models and scenarios make sense to evaluate at this stage. You always want to be driving to operational excellence through innovation. Now, in many cases, this means technology and looking at the technology to manage a supply chain, a manufacturing operations, or even a distribution network. But it doesn't necessarily have to entirely encompass technology. You can look at other ways to innovate, whether it be different models associated with your distribution network, or different manufacturing methods used within the business processes. Another item within the supply chain, clearly when we talk about supply chain, a focus is on the suppliers, and we need to look at supplier behavior within an organization, as well as the adherence to standards that are established. Oftentimes we look at organizations and working with them on their supply chains, they become comfortable with a particular supplier or an overall supply base and just run with that particular supplier for a number of years without questioning the year-over-year price increases that you're incurring. So we want to look at that supply base, evaluate the role and relationship each key supplier has within the organization. And quite honestly, frequently what we find is that there are a handful of truly strategic suppliers that a better term for them is a partner in your business operations versus I'm going to hesitate using the word commodity suppliers here, but there often is a set of suppliers that you can jump from supplier A to supplier B to supplier C, essentially with impunity. It will not impact your product, and the decision is almost entirely cost-based. But what this is all about is identifying which suppliers fall into which category and treating them appropriately. So as you complete the supply chain DNA manipulation, the next step is moving into that sustainability. And oftentimes what this really is a transition from the shock of change, because, again, looking back at the past year, we all had to do to a degree, supply chain manipulation or DNA manipulation, because the supply chains were constrained in many areas, oftentimes cut off entirely because of the pandemic and the lockdowns occurred. So organizations were forced to manipulate their supply chain and find alternative supply lines for the products that they need. Well, we then need to transition from this initiative of identifying alternatives to how is this now a sustainable focus for the organization, and how do we maintain the growth or cost savings as well as manage the risk avoidance over time. So sustainability, it does have a focus on and a drive for profitable growth-enabled actions. Going back to when we looked at the 4 categorizations of opportunities, those opportunities that drive profitability often belong over in the sustainability guidepost. And that's where we want to focus on within this guidepost. I've mentioned a number of times the need for risk management, risk monitoring, supplier monitoring. What the sustainability guidepost does with the appropriate use of technologies and data is it has the ability to provide nearly real-time supplier risk monitoring and management. So instead of waiting for a quarterly review or a semi-annual review with our suppliers, with the way data is available now, we can now look at them on a much more frequent basis, whether it be monthly, weekly, or in some cases, I've actually seen daily performance metrics published for very key and critical suppliers. And that allows for proactive management of the overall supply chain and supply base. Now, I also mentioned, I've mentioned the pandemic a couple times. Quite honestly, we're sitting on the cusp, if not already in a resurgence associated with COVID-19. And while the vaccine has some, or I should say, is providing some assurances that we are going to emerge sooner rather than later, the reality of the numbers that we're seeing, not just locally, but nationally and internationally, is that we across the globe are experiencing a resurgence of COVID-19 right now. And while we're not here to talk specifically about that, this does highlight the fact that we have spent, and I can state this for me specifically, the past 20 plus years of working in supply chain management, risk has been minimized. We never thought twice about running to new countries, to developing countries, in order to pursue cost savings. Well, the times have changed, and whether it be a resurgence of COVID-19 or whatever the next black swan event might be, we have to be looking at those events and being able and have the ability to react appropriately. And this goes back to the planning that we spoke about earlier and making sure that we have appropriate plans in place. Excuse me. And finally, it brings us to the executing strategic and business alternatives with discipline and rigor. I mentioned when we talked about the supply chain DNA manipulation, we have to be very firm with our approach. The same goes for sustainability. You can't just take I'll refer to it as the spaghetti approach and throw the spaghetti up against the wall to see what sticks. That's absolutely not how this should be working. You want very defined project management, and there's as well as the strategic vision. And there's a reason for that. When it comes to sustainability and the initiatives associated with sustainability, oftentimes, especially if you're looking to position an organization for sale within the next 6, 12, maybe even 18 months, you're not going to realize the fruits of some of these labors. However, if you have programs in place, well documented, you can present those as part of the purchase package to exhibit that we are in a path of continuous improvement, and we have these programs in place. It's not going to be a hard dollar impact per se, but it does have the potential of changing certain opinions about the strength of an organization. Now, you might ask, okay, lot of fun words, a lot of good information to consider. Well, how does this all come about, and what type of specific initiatives might we be looking at? And in the next set of slides, or really the next slide that I'm going to walk through here, is going to show you what some very specific initiatives and where they play within the guidepost. So first and foremost, I mentioned the geopolitical as well as the disruptive competitive pressures. Those are not things that are readily controllable. However, I do want to stress that they oftentimes are addressed, and more specifically should be addressed in your strategic planning as well as strategic sourcing. The difference being strategic sourcing is really a solution to how you view that overall supply chain and where you're buying goods from. The combination of those two strategic plans should address, or at least help articulate, what the organization feels are some of the risks and competitive pressures that they will be faced with in the not just the near future, but also the long-term future. Now, obviously, tactical planning, how we execute specific activities over time, that goes over guideposts 3, 4, and 5. And I have to stress that organizations do need to have tactical plans. That's, looking at how we're executing the orders that we have in place today, as well as focusing on what the forecast is in the future and how we're going to achieve those particular goals. Whether the forecasts are hopefully looking at growth coming out of the pandemic, or depending on industry, maybe there's a recognition that, we have some significant challenges because, truly this pandemic in certain industries is changing our culture and how we're going to view certain sub-industries. And maybe that results in a decrease in revenue that needs to be planned for. Hopefully that's not the case, but that's where our tactical plans come in. We also look at a number of diagnostic dimensions, talking about procurement, how we're specifically buying goods, the terms and conditions associated with those purchase orders. Intelligent sourcing is really the merging of procurement with your strategic sourcing plan and how we have appropriate data-focused decisions to make associated with the sourcing and procurement activities. We mentioned distribution logistics projects as well as reverse logistics. Again, depending on industry, we look at a number of retail organizations, and reverse logistics is going to become a much bigger item for them as they transition from your brick and mortar storefronts to more online sales, which I think we've all seen over the past few years as happening. Also, distribution and warehousing activities, again, going to what appears to be emerging as some of the new economies that we're going to be dealing with, more online sales versus brick and mortar. The sustainability aspect also allows us to look at what's referred to as nearshoring, or oftentimes right-shoring. I mentioned the example of organizations looking to move from China back to North America. But there's also movements within North America, looking at other regions, looking within different states within the U.S. as to where operations should be existing. That's all part of the nearshoring or right-shoring efforts. Bill mentioned earlier, ensuring that you have the proper team in place. What are the team strengths? That goes directly to sustainability of initiatives and of the organization as a whole. Finally, we have some, I'll call them technology-focused potential projects. So we have technology enablement efforts. There are also advanced analytics, oftentimes tied with dynamic costing, looking at how we're costing products. And then there's the ever-popular Industry 4.0 concept, looking at how things get tied into the internet and enabling those features. Again, these are initiatives that you may have looked at over time, but when we're tying out how to improve the valuation of an organization, these particular items often are long-term efforts to put in place. So depending on the time frame for where you're positioning your business for sale, might dictate whether these get looked at or not, as well as how you want to strategically view them. So with that, thank you very much for your time. I believe we will be entering into our Q&A session now, and Bill and I will be available to field any questions you have regarding this presentation.